Our next topic on the roadmap is to look at cash flows and the important financial statements. We remember from session 2 that the cash flow identity or equation is cash flow from assets equals cash flow to creditors plus cash flow to stockholders. CFFA equals CFTC plus CFTS. Cash flow in equals cash flow out. It's important to know what are sources of cash and what are uses of cash. In fact, the statement of cash flows used to be called the sources and uses statement or the sources and applications of funds statement. Now it's just called the cash flow statement, but it's important to know on that statement what things are sources of cash and which things are uses of cash. Sources of cash at the very bottom there are an increase in the right side balance sheet, basically. And uses of cash are increases in the left side of the balance sheet or a decrease in the right side. You can see from those bullets there. Increase in accounts receivable is a use of cash. Inventory going up is a use of cash. Buying some net fixed assets, property, plant, and equipment is a use of cash. So in general, we can say this: if we have a decrease in the left side or asset side of the balance sheet, except for the cash account itself, generally a decrease in the left side asset account or an increase in the right side liabilities account are sources of cash. The left side going down, right side going up gives me a source of cash. Uses of cash will be an increase in the left side of the balance sheet, like an increase in inventory. That means we use cash to buy inventory, or a decrease in the right side, which means we paid off some of our liabilities. Statement of cash flow is maybe the most important financial statement, and all it is, after doing hundreds and hundreds of these myself by hand in a lot of cases, simply net income plus depreciation plus changes in the balance sheet. So to do a statement of cash flows, I need to have built an income statement and a balance sheet. And here's an example, a good example. As I said, it's basically very, very simple. It's net income. I add back depreciation and then changes in the balance sheet. So if my accounts payable go up, that's a source of cash. If my accounts receivable go up or my inventory goes up, that's a use of cash. And these are color-coded so you can tell which are uses and which are sources. If I buy some fixed assets, so fixed asset acquisition is part of investing activity or investment activity. If I buy some property, plant, and equipment, that is a use of cash, and you can see that denoted in red. Finally, financing activities, things like dividends paid, that's obviously a use of cash. If I increase my long-term debt, that means I borrowed some money. If I paid off some long-term debt, or in this case, some notes payable, it's a right side balance sheet item going down. That means I paid some things off. That's a use of cash. And you can see these items are color-coded, and we can see that we had a very good year from this statement of cash flows. So again, these statements can be used to evaluate the success of a company. All three, income statement, balance sheet, and statement of cash flows, can go a long way. In addition to ratio analysis, can help us determine whether a company is successful or not. Statement of cash flows is currently the new way of doing things, is to break it into three sets of activities: operating activities, investing activities, and financing activities, as I mentioned before.